Show me the money. This is the Moneyweb Be a Better Investor podcast, picking the brains of professional investors on their investment strategies, successes, and mistakes. Your host, Ryk van Niekerk.
Welcome to this week's edition of the Be a Better Investor podcast. My name is Ryk van Niekerk, and in this podcast series, I speak to leading professional investors and business leaders about investments. And we also take a peek into their personal investment approaches and portfolios. We try to understand how they analyze investment opportunities, what companies and assets they invest in, and whether they have more hits than misses. The idea is to identify a few golden nuggets of wisdom to help amateur retail investors to become better investors. My guest today is Pheiffer. He's the Chief Investment Strategist at Sasfin Wealth. Now, he had a very interesting investment journey. He was the Chief Investment Strategist at Sasfin in the early 2000s. He was in this role for around 7 years. Then he moved to stockbrokers for around 16 years. And then he moved back to Sasfin and assumed his old role as the Chief Investment Strategist. Craig, thank you so much for your time today. It's an interesting investment journey. Why did you return to Sasfin? Many people won't return to a company they've worked for before, especially after you've been at Absa for 16 years.
Well, I think when I left Sasfin in the early days, in 2007, it was more about just getting a broader exposure. I think in those days, you sort of felt like you'd done it all. You were doing a lot of repetitive stuff every month. You wanted to broaden your horizons, or I wanted to broaden my horizons. And you get maybe the imagery of you think you're a big fish in a small pond, and now you want to see what you can do in a bigger pond. So I went out to Absa. Yeah, it was a good 15-odd years there. The company also morphed. I joined as the head of the private client asset management business, which eventually over time merged with the stockbroking business. There were kind of a lot of similarities in the back office and even in the front office. So that's why we joined those two companies together. And yes, it's just the investment game wherever you are. It never gets any easier, but it's exciting. And I think I just wanted going to Absa was to see how I could fare myself in a bigger environment.
It never gets easier. We'll talk about that in a minute. But let's go back. Where did you grow up, and when were you first exposed to the investment world?
Go back. I was actually, my parents, when I was born, lived in Louis Botha Avenue, overlooking St. John's in those days, in a block of flats. Still drive past there sometimes when I'm brave and see where we used to live.
Now you just need to watch out for those taxis.
Yes, but eventually, long story short, I ended up in Alberton just before my 9th birthday, and I've been in Alberton ever since. Always a long journey in the mornings or whenever into the office in Sandton. Invariably, I've worked in Sandton. So the traffic's never great. So COVID was a good experience from that point of view because I didn't have all of that travel, and you sort of get used to having more time on your hands to do what you're supposed to be doing, rather than sitting in the traffic. Yeah. But even this week, going back one afternoon, it took me 2 hours to get home. On a bad day with the rain and the load shedding and the robots. So I've been in Alberton virtually all my life, coming up to be 57, so it was just before my 9th birthday. There was a time when we looked to move closer. We spent about a year looking at houses closer to Sandton, and eventually moved, a kilometre away from our old house.
Yeah. And the investment world, when were you first exposed to it, and when did it start to really tickle your fancy?
I think I had an interest in it, very early on. When I was at varsity, I was aware of the financial markets. This is sort of mid-80s.
You studied economics?
I first did a BSc in computer science. That was what I did at Wits. I think to this day that I did the wrong degree initially. Once at that age, I was 17 when I went to varsity, 17 and a half. And you're not quite sure. You don't always get the right guidance. And I just knew I wanted to be in computers at that stage. When I was at school, I had a little ZX80 computer. It was a little membranous keyboard. It had 1K of memory, and you could get a little 16K add-on in the back.
I remember those. I'm also giving my age away.
And so it was all about computers. But what I should have done was probably go into business information systems on the financial side, because I sort of a BCom in that space, because that was probably marry my two kind of loves at the time, or my two interests, let's say, at that point in time. But I did the computer science degree. I looked around. I did my military service, ended up doing 18 months. It was just being phased out then. And I remember I got 2 job offers after all my interviews. The one was for, I'll tell you the numbers, was for 2,200 Rand at the stockbroker, and the other was at 2,800 Rand at Unilever. There was a massive difference in the money. But I chose to go to the stockbroker because that's where I was more interested, and I thought that's where I want to have my career. But in my varsity days, my first little foray into the markets, I think, was buying Escor shares.
Was that the very first share you invested in?
That was the very first share I got. Got to experience, Black October, and things don't always go up in a straight line or even up. When I joined the stockbroking business, my first share that I bought was McAdam's Bakery Supplies. I don't know why. It just there was nothing about valuations or anything. I didn't know anything. I was doing a BCom part-time at that point in time. So it was one of those things, I don't know, maybe just seemed sexy and as far as bakery supplies go.
Did you make money on Escor?
I did in the end because they unbundled. And they also had a lot of rights issues or splits, and I stayed with it the whole time. You got Kumba out of it and Exaro.
Exaro, yes.
And then your Mitchell shares, which those just went south after that.
Do you still own it?
I still hold all of them, to be fair.
But the net effect would be a big positive because
the net effect,
Exaro and Kumba has performed phenomenally at times.
At times, yeah. I think that probably comes down to my strategy, or maybe it's just neglect sometimes, but it's to try and buy good shares and keep them for the long term. Just hold on to
Fire
them.
and forget.
Yeah. And that works probably with 90% of the shares. But you have to continually look at them as well and monitor them. You don't necessarily have to trade them. But I think you do your homework, you buy the shares, and you just stick them away, generally.
Let's talk about that, do your homework. So you were a very young, excited individual entering the stock market or stockbroking business. How did you do your homework? Because I would assume it's totally different to the way you do it today.
Yes, in those days, I think it took a lot of guidance from my mentors in the business, those people that I reported to or worked with in the business. And I like to think that, one of them was an angel on my left shoulder. There were 2 of them. And the other was a little bit of a devil on the right shoulder. And the angel would tell me, buy good shares and keep them. Don't trade in and out all day. The other one on the other shoulder would say, buy those gold shares in the morning, sell them in the afternoon. And the angel on my shoulder, pulled me aside one day and said, have a look. Which of the 2 of us is the most successful here? And that was quite a defining point, I think, for me in how I developed my overall investment philosophy, or how I thought about markets. You can do a bit of trading. Sometimes it's exciting to do that, but it's on the side with a small part of your portfolio. Rather look at good stuff, and I'll get to that valuation, but or what's good stuff. My little angel helped me there with what I think was my very first investment, and that was in Sasol shares. I remember at a point in time I got a bonus of 2,000 Rand, and I went out and bought 50 Sasol shares at 40 Rand, and I just kept them there. I didn't do anything. I still have those shares to this day. Maybe that's not a good thing anymore. But, over time, that idea was also reinforced by my father-in-law, who also liked to dabble in the markets and he had his own investment portfolio. But he loved it that I was in the investment business, and I was the guy he could always chat to about things. But he always reminded me about, he bought Sasol, on day one when they listed, and it was 1 Rand or 2 Rand. I think they were 1 Rand and they started trading at 2 Rand or something like that. And, he also just kept them over the years. And when he passed, we actually had to sell them out of the portfolio eventually.
Yeah, I think one of the benefits of being a long-term investor, especially when you invest directly into equities, is the dividend yield. Because a company like Sasfin has, since it started, the past few years may be an anomaly for reasons we're not going to go into. But have you calculated what your dividend yield is today based on what the dividend is, what's being paid, say, last year, based on the actual investment amount you put in
it
30
would
years
be,
ago?
I haven't done that exercise, but if you could think about even the cost price, in a year in later years you were earning a dividend that was equivalent to what you paid for the share virtually. And you got that multiple times and continues to pay. The company as well has come into its own troubles, as we know, and the world's moved on and it's becoming more greener. And sometimes management, if you hold it for decades, management changes and it's not always the same people that you invested in that company. That's why you have to keep looking at it and investigating that it's still good fit for purpose.
Yeah, the longer you own a share, the more cycles there will be. And it will be interesting to see what Sasfin does over the next few years, because it definitely needs to refocus and restructure the business in a greener economy. But that brings me to the point. Many people buy a share and for the long term, and it performs really, really well. Should you look at a possibility of exiting that share to take a profit and maybe invest it in something else? How do you think about that decision, when to get out after a good performance?
That's why I think you do need to continue to evaluate whether the company remains a good investment. It's not the case that if you've got a 1-year target price today and it reaches that price tomorrow, they're necessarily going to sell that for myself or for the investments for our clients. We buy these shares, now I'm talking from a investment manager point of view, for a much longer time horizon. And I'm thinking now, when we look at shares, we want to hold them for 10 years plus, that kind of time frame.
Does it always happen? Do you, all of the investments Sasfin make, do you hold it for 10 years, or how often do you deviate from that strategy?
Look, there was, sometimes shares just become really, really, really expensive on a valuation point of view, and you kind of feel compelled to do a little something. We did that. We cut back on NVIDIA, and that was the wrong thing.
When did you cut back on NVIDIA?
Look, it had grown quite chunky in the portfolio, and we cut it down at about 400 Rand, and now it's 600 or whatever. So that might not be the best example of doing it, but it was a risk management tool in the overall portfolio. When the share just gets too big in a portfolio, you want to do it more from that point of view than maybe for the individual merits of the share itself. Mm-hmm. Again, there is merit in being concentrated, I think, in the portfolio, not having hundreds of shares and diluting the performance of all of your shares.
But I think the key point is you don't need to sell everything when you decide to reduce your exposure, because sometimes if a share becomes 20, 25, 30% of a portfolio, it presents an inherent risk. So you can trim it down and invest it somewhere else, and yes, you can make mistakes. In 2020 hindsight, all the mistakes are very, very clear. But that is an interesting strategy to follow, and it's one you really need to craft to perfection. I don't know if that is possible, but how much do you actually trim it down when it has performed really well?
If I think about our global equity portfolio, there's about 24 shares in there at the moment. And when they start getting 6-7%, we sort of trim them back to maybe 5% or so. And that's maybe a small tactical move, and we don't do that a lot, because we are looking at shares. We're looking at companies that firstly have a great track record. They've got a great return on capital, so they are the capital that they have got, they are providing good returns on, the income is there, and they reinvest into the business. So over the longer term, you get that compounding of someone that reinvests in the business, keeps growing. So you've got to have that history for a start. And you as an analyst, got to have the expectation that that's going to continue into the future over the longer term. So we want those kinds of companies. Those are the ones we look for that fit a kind of growth mold and a quality mold. And those ones you can keep for a long time, but maybe you just tweak the weighting in an overall portfolio from time to time.
Let's talk about shares that underperform. Say you've done your analysis, you've spoken to many people, listened to the angel on your shoulder, and you invest in a company and it just does not perform. It performs poorly. You've got the 10-year investment horizon. At what stage would you cut your losses?
I think firstly it's not a shame to sell something that's gone down and hasn't played out the way you thought it would. Sometimes there's other circumstances that come to play that one could just never imagine, those kind of black swan events or whatever they may be. In my personal portfolio, I once bought Sappi, I remember, at 117 Rand, and it started falling more and more. And eventually I thought I got out, I think maybe it was 90 Rand or something, but it just kept falling into the teens even. So that made me think that maybe sometimes you have to, it makes sense to sell a share for a reason. But that's, a lot of traders have that mentality of a stop loss, if it goes down 10%. That's not how I think of it from an investment point of view. I think you've got to just reassess whether this is still an investment you want to be in. Is it just a temporary blip? Are there things that are just clouding over the issues just in the short term? Companies like Apple, they go through these patches of cloudiness, and China doesn't want their people to use the iPhone anymore, and then the market gets a little taken aback, and the share slumps for a bit. But then they come out with results again, and they've managed to sell iPhones somewhere else to overcome the slowdown in China. And hey, look, we've got these fancy goggles, and things move along. So You've got to see what's just cloud and noise, apart from something that's maybe structurally gone wrong now with the company.
Yeah, I think a company like Apple redefined itself with the iPhone. They were nearly bankrupt before they launched the iPhone, and look at it now. One of the biggest companies in the world. I've spoken to many investment professionals on this podcast, and there is a feeling that a hit-miss ratio of 6 out of 10 or 6 to 4 is a benchmark. 6 winners for every 4 losers. Do you agree with that ratio?
I think it is, it is probably, firstly, you want to have more winners than losers. So that is probably a fair number. It's what you do with those 4 as well when they're falling or not fit for investment anymore. Whether you hold them on for too long or you get out of them at a particular time, it depends on your overall success then in out of your 10 stocks. I suppose. But yeah.
And you want those 6 shares, the 6 winners, to totally outperform the losers. And that's where you actually make your alpha or your yield.
Yeah, very much so. And I think, 6 out of 10 is fair. Maybe you'd want to stretch it to 7. If you're looking at those longer term, you've done that homework. You're prepared to stay there for 10 years. Great track record. Looks great going forward. And the success will be defined over the longer term. It's not you don't always know in year 1 or year 2 if it's a 6 or a 4.
Yeah, absolutely. It won't be constant. That's a good point. Let's talk about retail investments from young professionals who enter the market. So what would your advice be to yourself when you stepped onto the stockbroking floor, what did you say, 1990? What advice would you give yourself to maybe try and ensure that your investments at that stage were better?
I think at that point, you get excited, you want to be in the market. And as I said, I went for McAdams Bakery Supplies and Isco and, a couple of shares, and you go by hearsay and you like the individual names and they've got stories. And I think longer term, I love being in individual shares. But If I talked to my younger self, I would have said, in those early days, instead of buying the bakery supplies or Toco, I think there was a
sweets from heaven.
Those kinds of
listed,
things. Maybe just invest in the index at that stage. If you've got a couple of
$100,000. Could you have invested in the index at that stage?
Sure.
I think Satrix 40 only launched in 2000.
I can't remember, to be honest, but that might be a fair comment. But maybe to investors today, young investors today, rather try and build up your portfolio from a growing market in that way. And there are so many options these days as well. And I'd say, apart from just buying a Satrix 40 or a ETF that follows the local market, look at the offshore ones as well that are listed locally. That I would have definitely said, get into that as soon as possible. When you're younger, you don't think about expatriating rands into dollars and all of that, but you could buy a local ETF in rands that tracks the S&P 500 or the global markets. And that, when those markets go up, you benefit, and when the rand depreciates, you benefit as well. So,
there are many of those, index tracker funds of international stock markets and countries, which you can invest in rands. The MSCI S&P 500 is one. I invested for my kids in that fund for many, many years, and it's performed phenomenally, especially if you take the depreciation of the rand into account. Lastly, let's talk about your best investment ever. Which investment you have made with money you've earned, that's important. Which investment are you the proudest of? Which one has made the most money?
Having worked at ABSA for 15 years, I did manage to earn a few ABSA shares in my day. Before that, I actually bought, it might have been 100 ABSA shares or something at 10 Rand, and those have done well. As the years go on, the share itself might not always run away, but it has grown over the decades. But it pays a fantastic dividend, and that's always nice to see on your statement that when they pay dividends every half year. But I think the best investment I ever made was actually for my wife's portfolio. At the time, we had a little portfolio for her, and Richemont came out with a trading update, call it a profit warning even, in those days. And the share went, this is going back some, I think to early 2000s, from 13 Rand, it traded down to 9 Rand. And I said, Richemont is a great company. This is a fantastic opportunity. We're buying it on the day of the profit warning. It still went down further, I think to 8 Rand 50 or 8 Rand, or maybe even a bit lower than that. But we just stuck with it, and then it had its splits and all kinds of things. And I think that has been a fantastic investment. And actually,
what is the share price now? Well, you're split.
Well, we had them now. We were trading the depository receipts here, and those were now merged into one. So now it's it's in the thousands.
And Raynet was spun out of it. Remgro as well.
Yes. No. So you've done very, very well.
No, absolutely.
I also, sometimes you also get a little bit lucky. I remember buying De Beers, and then they had a takeout quite shortly after that, and you got a bit of a premium. But that's just a bit of luck. It's not anything more than that.
Before we get to your worst investment ever, you referred to dividends. Do you reinvest dividends, or you take the cash and take the family for a fantastic dinner?
No, I've stuck with my principle that in my stockbroking account or my investment account, whatever's generated in there stays in there. Sometimes the cash pile grows up, builds too much over time, and you're actually a bit neglectful, and you should be reinvesting into the shares, but it all stays in there. So at least you're earning interest if you're not. Definitely reinvestment is the key, I think.
Yeah, I think that compounding is, in the long term, can be very, very significant. Let's talk about your biggest dog you've ever bought. One you don't really want to talk about, but tell us which one you think you may have gotten really wrong.
I think there were a couple, and I can't maybe think of all the names, but sometimes when you work so close to the coalface, and we're working at a stockbroking firm, there was the 2007 listings boom, and there were so many new companies coming in, and you'd go and listen to their stories, and they would sound appealing. I remember Interwaste was one. It's not listed anymore. There were a couple that, I took a small interest in them, but some of them came to naught, actually failed and you got nothing back. So there were a few of those in 2007, and maybe that holding on strategy didn't work for that, but maybe it was also just I didn't think about it because it was, that was fairly small. But that was probably a time when I just thought, you don't need to go chasing all of these little bits of excitement. On the other hand, one of the listings in Afrimat has done extremely well. I think it was also sort of a 2007 listing stock. So that's, converse story there. So I've still got Afrimat, and some of those shares have come to naught as well.
It's performed well. Greg, thank you so much for coming in today and for sharing your insights.
No, thanks very much. It was great having a chat. Thank you.
That was Greg Pheiffer. He's the Chief Investment Strategist at Sasfin Wealth.
Show me the money. That was the Moneyweb Be a Better Investor podcast with Ryk van Niekerk. Thanks for listening. Catch up and listen to all the Moneyweb podcasts on moneyweb.co.za or the app. Moneyweb, your trusted source for business and investment insights.